learning about price patterns. In this video, we will be learning about the triangle pattern. Let's start with the descending triangle pattern. In the descending triangle pattern, the prices go down sharply, then they move up and down, and they tend to become range bound in a triangle form, right? As you can see here, right? And then when it breaks out of that triangle, it moves sharply down. So you sell here. The prices are supposed to move down as many points as the move that it had when it sharply fell down in the first place itself. Your stop loss can be 4 to 5% of your capital. Opposite to this pattern is the ascending triangle pattern, where the prices sharply move up and then they become range bound, as in they keep moving in that range until it forms a triangle, and then it breaks out of the triangle. So you buy here. The prices are expected to move as many points as the initial sharp movement it had, and your stop loss can be again 4 to 5%. We will look into an example. So this is a chart of MRF again. If you can see here, the prices went up sharply and then it became sort of range bound over here, and if you connect the points, it would look like a triangle. Then it broke the triangle at this point and the prices went really up. So this was the triangle pattern for you, and this was the last pattern of the price patterns. From the next video, we will start indicators. You can also follow my Instagram handle, which would be given here, where you can see the trades that I take using these concepts. That would be all for today. Take care, and I will see you in the next video. Cheers.